The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
China is refusing to negotiate with President Trump on U.S. tariffs. In fact, the nation is taking the trade war to a new height.
In just 90 days, more than $120 billion could vanish from the United States. Wall Street may reel, businesses of every size could be thrown into panic, and ordinary Americans, already grappling with inflation and joblessness, now face another economic tsunami. At the center of the storm is a cold, decisive move by Beijing, selling off U.S. bonds and pulling investment from American markets, including crucial semiconductor projects. Back in 2018, the trade war paused after both sides sat down and struck a tentative, mutually beneficial deal. Fast forward to 2025, President Trump's second term, and China has launched a direct, forceful counterattack. It has rejected every new round of talks, and the threat of canceling U.S. transactions is no longer remote. If Beijing refuses to keep playing the role of Washington's quiet banker, America stands to lose more than cash. It could forfeit economic stability. Is China betting everything to outmaneuver Trump 2.0? And will American citizens be the first to pay the price? Join Deep State as we dig into this high-stakes climax of the trade war. And don't forget to hit subscribe and turn on the notification bell so you never miss our latest updates. When Donald Trump won re-election and returned to the White House in 2025, he made no secret of his ambition to make America great again, once more. On the political stage, that promise has taken shape as a full-scale economic offensive with China, Washington's biggest trading partner and most formidable strategic rival, sitting squarely in his crosshairs. According to the Office of the U.S. Trade Representative, two-way goods trade between the United States and China reached $582.4 billion in 2024. After Canada and Mexico, China ranks as America's third-largest trading partner. From the first days of his new term, President Trump moved quickly to ramp up tariffs on imports, especially those from China, 10% covering items such as electronics, steel, and household appliances. But when several rounds of talks collapsed, Washington did not back down. Instead, it kept piling on pressure. By late 2018, the rate had leapt to 25%, and by mid-2025, barely 5 months after Trump's second inauguration, the administration had lifted duties to 34% on high-tech products, particularly semiconductors, the backbone of the global industrial chain. The White House argued that the hikes were needed to narrow America's swelling trade deficit with China. In 2024, that gap stood at nearly $300 billion, underscoring how persistently the United States relies on goods from the Asian giant. U.S. exports to China totaled $143.5 billion in 2024, down 3% from 2023, while imports surged to $438.9 billion. What the Trump team failed to anticipate was how quickly and fiercely Beijing would hit back. China not only slapped tariffs of 84% on key U.S. imports such as farm products, automobiles, and energy, it also issued an unprecedented warning. If Washington raised duties to 245%, Beijing would impose a blanket 125% tariff on all American tech goods, an open declaration of economic war on U.S. electronics, defense, and chip industries. China's response has not stopped at tit-for-tat levies. Beijing has begun quietly pulling investments and industrial contracts out of the United States, striking at supply chains already fragile after the pandemic and global inflation shocks. Data from the Observatory of Economic Complexity show that America depends heavily on Chinese manufacturing to meet domestic demand for consumer and tech products. Top imports from China include phones, computers, semiconductors, furniture, toys, and textiles. Electronics and machinery alone account for more than half of the total value. What started as a tariff skirmish has now swollen into a full-on trade war. In the eye of this storm, the U.S. economy has started to shudder, perhaps not because of China's retaliation alone, but because Washington may be isolating itself from the very global network it once dominated. When the Trump administration raised tariffs to 34% and even threatened 245% on key strategic technologies, many thought Beijing would blink. Instead, China took the opposite road. No concessions, full confrontation, and a sweeping plan to rebuild its tech supply chain in ways that could upend the entire global order. Within weeks of Washington's new duties, China slapped a matching 84% tariff on U.S. imports, ranging from farm goods and cars to energy equipment and even civilian defense products. Dozens of supply contracts between American firms and Chinese state-owned companies were either canceled or indefinitely frozen. Trade between the world's two largest economies turned ice cold almost overnight. Reuters data show that in the first quarter of 2025 alone, China rejected more than $18 billion in U.S. goods, double the figure for the same period last year. What stunned analysts, however, was Beijing's decision to sever its Western tech lifelines. China formally ended semiconductor cooperation deals with heavyweight suppliers, such as ASML of the Netherlands and Taiwan's TSMC, the world's largest chip maker. These two firms are the beating heart of the global tech chain. The United States has long relied on them to stay ahead in advanced chips for everything from phones and cars to smart weapons. Although Taiwan is small, it produces nearly 60% of the world's semiconductors and almost 90% of the cutting-edge chips that power smartphones and artificial intelligence systems. Now, Beijing is not only cutting that cord, it is building a fully self-sufficient tech ecosystem. Shares in global tech fell sharply after the announcement. ASML dropped 7.6%, and a 3-month semiconductor sell-off has erased roughly $2 trillion in market value. TSMC may slow some expansion projects as weaker demand and tighter U.S. rules on NVIDIA sales to China deepen the downturn. Bloomberg intelligence analyst Ken Hoey warned. CNN reports that China has approved a colossal state-backed fund worth $47.5 billion for its domestic chip sector, focusing on AI processors, quantum energy devices, and ultra-miniaturized microchips. The fund came just days after Washington imposed sweeping export curbs on U.S. chip technology aimed at stifling China's tech ambitions. Chinese chip stocks soared on the news. Semiconductor Manufacturing International Corporation, SMIC, the world's third-largest contract chip maker, is up 7% this week, while Hua-Hong Semiconductor, the country's second-largest foundry and a Huawei supplier, has jumped 13%. This is more than a defensive play. It marks the opening salvo in President Xi Jinping's long-term plan to free China from U.S. tech and turn the country into a global innovation leader. Once the hub of world technology, America's position is now under serious pressure. The fallout for everyday Americans is already painful, as China cuts ties with Western tech firms. Supply chains are breaking apart. Many U.S. plants from Texas to California that rely on Chinese parts, software, or joint R&D have been forced to halt production. According to the Bureau of Labor Statistics, America lost more than 126,000 high-tech manufacturing jobs in the first quarter of 2025, the steepest drop since the COVID-19 pandemic. What we are witnessing is no longer a simple tit-for-tat tariff battle. It is a comprehensive technological and strategic divorce between two superpowers. For decades, the United States dominated through core technologies. Losing access to that supply chain and to the know-how behind chip production would not just be an economic setback. After building a self-sufficient domestic tech ecosystem that no longer relies on Western components or know-how, Beijing is now poised to strike directly at America by yanking its money out. According to the Peterson Institute for International Economics, China withdrew more than $120 billion from key U.S. sectors in the second quarter of 2025, targeting technology, renewable energy, commercial real estate, and the electronics manufacturing supply chain. For nearly 2 decades, China has been not only a major trading partner, but also one of the biggest investors in U.S. tech giants. Chinese-backed funds, such as Hill House Capital, Boyu Capital, and the sovereign wealth fund CIC once held stakes across Silicon Valley from chip makers and AI labs to electric vehicle startups. Now as Beijing pulls out, shares in those firms are being dumped and many ongoing projects have stalled for lack of cash. The shock came so fast that analysts were caught off guard. In just 3 months, more than 2,800 U.S. tech projects have been put on hold, mainly in microchips, industrial robots, and AI supply chains. The National Venture Capital Association reports that total U.S. tech venture funding in the second quarter of 2025 fell almost 41% from a year earlier, the biggest plunge since the 2008 financial crisis. With thousands of projects frozen, a wave of layoffs is sweeping the country from San Jose startups to electronics plants in Texas. Firms are downsizing, cutting staff, or filing for bankruptcy. The Bureau of Labor Statistics says the tech sector lost over 73,000 jobs in just 60 days, pushing unemployment in the field to 7.4%, double last year's rate. The capital exodus also puts America's blue-chip companies in a bind. Firms that once relied on Chinese investment must now scrape together domestic funds or borrow at higher rates, even as the Federal Reserve keeps money tight to battle inflation. Production costs are soaring. Many companies are raising prices to cover losses, and consumers feel the squeeze. A mid-range smartphone that used to cost $499 now sells for about $580 after only 2 months. Prices for electric vehicle components are up 12 to 19% according to the Consumer Technology Association. This is just the beginning. America's supply chain cannot heal overnight without Chinese capital that had been rooted here for more than 15 years. Finally, China's cash flight is triggering a domino effect across U.S. financial markets. Stocks are sinking, and pension and insurance funds, heavy investors in tech, are losing value. It is not only corporations that suffer. Ordinary Americans, from office workers to factory hands, are starting to feel the financial tremors in their daily budgets and monthly bills. When Chinese capital floods out of U.S. markets, the aftermath is more than abandoned plants and cash-strapped companies. The deeper and more dangerous impact is a widespread investment shortfall across the entire financial system. American commercial banks, once flushed with funds from Chinese institutions, are now scrambling to stay liquid. According to the Federal Reserve's latest data, early April 2025, the average private sector lending rate has jumped from 6.9% to over 9.3% in just 6 weeks. While firms struggle with higher borrowing costs, the federal government faces an equally urgent problem. As China sells off U.S. Treasury bonds to reshape its portfolio, America's public debt burden grows heavier. Treasury data show that Beijing unloaded more than $38 billion in U.S. government bonds in March 2025 alone, pushing the 10-year yield to 4.5%, the highest since 2007. Rising federal borrowing costs are forcing Washington to redraw the budget map. Social programs, education grants, and even infrastructure spending are being trimmed. The fallout quickly reaches every household. Life in America is suddenly more expensive than ever. The Consumer Price Index rose 6.1% in the first quarter of 2025, with food and energy up 8.4%, sharply eroding buying power. Middle-class families in industrial states such as Michigan, Ohio, and Pennsylvania, once strong Trump backers, now feel the financial squeeze. Living costs climb, and so do mortgage, auto loan, and college tuition rates. Pew Research Center surveys show 57% of Americans say they are worse off financially than a year ago, citing higher prices and stagnant income as the chief reason. Economists warn that a full-scale recession is taking shape. Mark Zandi, chief economist at Moody's Analytics, estimates that if the capital exodus continues into the third quarter of 2025, the odds of a U.S. recession could double to about 35%, with unemployment topping 5.5% by fall. All of this reveals a painful paradox. A tariff policy meant to make America stronger now threatens to push the economy and everyday life into turmoil. The question is no longer whether President Trump wins the trade war. It is how much ordinary Americans must sacrifice to cover the cost of a hurried strategy from the White House. At first, analysts assumed China's massive cash exodus from U.S. markets was just another round in the familiar U.S.-China rivalry that flared in 2018. Only weeks later, everything changed. The trade fight is no longer a two-superpower feud. It has gone global, forcing Washington's longtime allies, the European Union and Canada, to pick sides in an increasingly polarized world. In Europe, the EU voiced deep concern over President Trump's new tariffs and warned of a chain reaction that could rattle global finance. Yet, instead of backing the United States as in past disputes, Brussels has chosen a very different path. It is speeding up economic cooperation with China in a symbolic but pragmatic move. The European Commission signed a memorandum of understanding worth more than $38 billion for digital trade expansion and renewable energy supply chains with Beijing. The deal includes Chinese investment in data centers and solar energy hubs in Portugal, Germany, and France. Europe's shift is partly strategic, partly defensive. As China pulls money out of America, some of that cash is heading into European government bonds, especially those of stable countries such as the Netherlands, Austria, and France. European central bank data show Chinese investment in EU bonds rose nearly 17% in the first quarter of 2025. A clear sign Beijing is reshaping global finance, bypassing the US dollar to build influence in the euro market. Across the Atlantic, Canada, America's close neighbor and stalwart ally, is also stepping back. The Globe and Mail reports that Ottawa is considering delaying or rewriting a string of trade deals with Washington, notably in energy and technology. The rethink follows Beijing's pledge to pour 27 billion Canadian dollars into Alberta's oil and mining sectors, and to boost farm goods imports from western provinces. Canada's pivot toward China piles economic pressure on the United States and poses a diplomatic headache. White House officials have rushed to keep Ottawa engaged, especially on defense projects and rare earth mining packs that are critical for chips and advanced weapons. Canada's silence, however, signals what many fear. Even America's closest partners are re-examining U.S. reliability amid policy turbulence in Washington. China's capital flight is cracking the once tight Western financial alliance. If core partners such as the EU and Canada chart their own course, the United States risks isolation in a contest it helped set in motion. In a world split by geopolitics and economic self-interest, the price Washington pays may exceed mere billions. It could jeopardize its global standing. America now faces a stark reality. It has not only lost strategic Chinese capital but is also losing the confidence of longtime allies. As the EU and Canada pivot in search of new partners, the United States is being pushed to the margins of the very network it once led. These rifts may not be temporary, they could reshape the global economic and diplomatic landscape for years. The tariff war, once seen as President Trump's ace to restore U.S. strength, has become a double-edged sword. The penalties have not forced China to yield. Instead, they have triggered a chain reaction that wounds America itself. And the first to feel the pain are ordinary Americans, from laid-off workers to families squeezed by rising prices. The question is no longer who wins a tariff showdown. Rather, is this the beginning of the end for U.S. economic primacy? Or will America learn from today's setbacks and find a more responsible path, one that serves both the world and its own people? The globe is watching every twist in this trade war. Deep State wants to hear your thoughts. Leave a comment below, and don't forget to hit subscribe and ring the bell for more breaking political insights.